This was the largest silver drop ever. What the hell's happened to the West? Creating $1 trillion in debt every 150 days or so. If indeed the banks, like you said, are getting on sides, have the record low short positions, or are neutral, that's something I've never seen before. 61 to 6,700. This liquidity event is not real strength. It's forced selling. And if I were wrong about that, then why do we see all of these deliveries? Why is China buying record amount of silver the same month it gets hammered? To get these banks that have been profiting from a short position for years to make the West and the Western system, the bond market, currencies seem stronger than they were, and to protect the military-industrial complex because of the massive need of silver and munitions and high-tech aerospace, things like F-35s and stealth bombers and all of these things that need lots of silver. These things are now changing, and it is physical possession that will win. And when no one stands for delivery, you can suppress the price. It's just like Bernie Madoff. When no one asks for their principal back, you can win. You can run a Ponzi scheme. This was the largest silver drop ever, and that's why I took comfort in the BIS coming out and saying, look, y'all, this was structural, not fundamental. Nothing's changed. And I believe that. And that's the message I would like people on this side of the pond and on that side of the pond to understand, is that this is desperation by some players that were trapped. And if I had to guess, this was okayed by the top, basically saying this is your last chance, get on sides and cover your stuff. And is there any coincidence we see JP Morgan covering 3.8 million ounces of silver at the very bottom? I don't know, is it? Maybe it is. Maybe they're just really good at timing. But I would just simply say that, I think people need to not get concerned with the price swing. Easy for me to say, I get it, because focus on what's really happening, focus on what the biggest players in the world are doing, and know that this is right out of their playbook. And the one thing that I would say to people to give them comfort is it really feels like the end of the ability to control the price on a substantive basis is happening because we've squandered the trust of the rest of the world, who is now coordinated, motivated, wealthy, sophisticated.
What looks like panic selling may actually be a controlled reset behind the scenes. As Andy Schectman points out here, labeling this drop as structural rather than fundamental conveniently shifts attention away from who benefited most at the bottom. When a major player like JP Morgan covers nearly 4 million ounces at the lows, that's not noise, it's positioning. The real question investors should ask is why price volatility spikes exactly when liquidity is thin and sentiment is weakest. If trust erosion is real, then control mechanisms may already be weakening. Next, Andy Schectman unravels why global players are no longer playing by Western rules.
These were countries that were third world for most of our lives that aren't anymore. In fact, they're very sophisticated and very wealthy and very smart, and they are beating us at our own game. So this won't last. And I would say, as you were mentioning, where the options expire here in a day or two, you're at the end of the quarter. I would expect to see the prices resume in the manner that we would expect them to in this environment here real soon, hopefully right after the first. But yeah, people are scared, Andrew, and rightfully so. You know, I talk about this kind of stuff happening all the time, and I reference the interview that you did with Bart Chilton, and I reference it in many of the videos I do, because I think it's really important that people understand the stuff that we are talking about is not a conspiracy. It happens. And the head of the CFTC told you that this stuff does happen. And, you know, but I think it was much easier for it to happen when everyone trusted the West and the Western institutions and the Western rule of law and the election process and the immigration process and all of the things that made people around the world say, what the hell's happened to the West?
End of quarter price moves often say more about positioning than fundamentals. As Andy Schectman points out here, the timing around options expiry isn't random. It's when maximum pressure can be applied to reset sentiment and shake weak hands. When former regulators like Bart Chilton openly acknowledge manipulation, it removes the conspiracy label and turns it into a structural feature of the market. The deeper issue now is declining global trust in Western systems, which historically anchored capital flows. If that trust is fading, capital may no longer behave predictably. Next, Andy Schectman discusses how that shift could reshape market power globally.
what's happened to those countries? I think once you cross that Rubicon and add into it massive fiscal irresponsibility, creating $1 trillion in debt every 150 days or so, being wickedly monetarily irresponsible as well, and then going around the world with a stick instead of an olive branch and an open hand, I think we are at the end of the rope as it pertains to the privilege we've had with these commodities. And it just feels to me like there's a realization at those levels. And maybe I'm just using wishful thinking, but I don't know. It seems like the act of desperation on this last slam down was unlike anything I've ever seen. And if indeed the banks, like you said, are getting on sides, have the record low short positions, or are neutral, that's something I've never seen before. And if that indeed is what is happening, I guess it does set the stage for the numbers we hear coming out of the big banks, 61 to 6,700. Or how about Michael Hartnett, the chief analyst for Bank of America, sell half of your bonds and put 25% of your assets in metals.
$1 trillion of debt every 150 days isn't just unsustainable. It reshapes capital allocation decisions globally. As Andy Schectman points out here, if banks are truly reducing short exposure or going neutral, that signals a potential regime shift rather than a temporary trade. When figures like Michael Hartnett suggest moving 25% into metals, it reflects concern about currency debasement more than bullishness on commodities alone. Investors should question whether bond markets, not metals, are the real warning signal right now. If fiscal credibility weakens further, traditional portfolios could face structural stress. Next, Andy Schectman shows how institutional positioning may already be adapting.
Same thing with the chief investment officer for Morgan Stanley. The 60-40 rule that they've used forever, he said, is broken. Sell 50% of your bonds, that's the 40%, put 20% in metals. Or Jeffrey Gundlach, the bond king, 25% in metals is not overweight. At the highest level, you're seeing them talking about this being something where price is not something we should fixate on right now, rather look at it as an opportunity, because if they're right, the second half of this year is going to be fantastic.
Yeah, and the way I honestly, the way I look at this is differently to a lot of people, and it's very similar to you. This gold did what it was supposed to do. We had an institutional liquidity event. It was the only liquid asset that could be accessed to get over this initial hump. The question is, what happens when it isn't the dollar rising, when it's the dollar collapsing? How much gold have you got to hedge your positions with, to hedge your wealth?
When Wall Street veterans start abandoning the 60-40 model, it's not a trend, it's a warning signal. As Andy Schectman points out here, relocating 20 to 25% into metals suggests institutions are preparing for instability in both equities and bonds simultaneously. The key detail most investors miss is that gold's recent moves weren't about strength. They were about liquidity during stress. If the next phase involves a falling dollar instead of a rising one, portfolio hedging math changes dramatically. That's where traditional diversification may fail when it's needed most. Next, Andy Schectman unravels what happens when liquidity itself becomes the risk.
Because essentially, the inverse of what we'll see ultimately is not just a war event, a black swan event that's a war event, but what happens when the whole system, you just talked about, the impossibility of funding this debt. So when it all implodes, and it will, and 100% certain it will, so, and the dollar goes to nothing as benchmarked against gold, you need your gold. You need the hedge. Thank God it was there to insulate the institutionals. These are all long now. Everyone's long. And except for the poor few people who now think it's all over.
Well, and I mean, that's a mic drop moment right there. And then I just want to stress to everyone listening, is Andrew's very smart and says things that are profound, but if you're not really paying attention, you may miss what he just said there. What he really said there is that this liquidity event is not real strength. It's forced selling, and everything settles in dollars, giving the dollar this big bump. But if that were true, that the dollar was strength and not the forced selling, then why are the treasuries selling off? Because the treasuries, to me, are the bigger function of the whole problem. And that is, if people are selling treasuries when they always would run to them in periods of strain like this, that's the key. In other words, typically you'd see dollar strength and treasuries being purchased, yields falling. Now we're seeing dollar strength because of forced selling and yields rising at the same time. They're dumping treasuries too. That to me is something that needs to be thought about as well, because again, the West has lost trust. And I think trust in the treasury market, where you're seeing this kind of fiscal irresponsibility and weaponization, as we've seen before, is something that we're already well past. So what he is basically saying right now is we've been given a gift. At least that's the way I interpret it, and I feel the same way. And these things, I think you have to see them for what they are.
Rising yields alongside a stronger dollar is a contradiction most investors are ignoring right now. As Andy Schectman points out here, if this were true dollar strength, treasuries should be rallying, not selling off while yields climb. The divergence signals forced liquidation, not confidence, which historically shows up during liquidity stress events like March 2020, when both bonds and risk assets face pressure. It breaks the traditional hedge framework most portfolios rely on. This is where silent risk builds under the surface while headlines stay calm. Next, Andy Schectman unravels why physical demand is exposing these cracks.
And if I were wrong about that, then why do we see all of these deliveries? Why is China buying record amount of silver the same month it gets hammered? And those are the reasons why what Andrew just said right there is exactly spot on. Couldn't agree more with you, Andrew. And, I appreciate your perspective very much. I think it's spot on. That's why you're one of my go-to sources every day. I try to keep up with what you're doing.
Andy, of course, and likewise, and you're a sage, and it really is the years of experience, and you're a straight shooter as well. Everyone can trust you. They've known you for years. You've been around forever and a day, and you're still actually looking pretty darn good for it, I must say. Goodness me.
Appreciate that, buddy. I do. And, we met in the Savoy once, and that's where I'd like to buy you a beer again, right around New Year's. And I'll tell you, it's our time, Andrew. It is our time, and it's never been more important to let people know what's really happening. And I have always felt that you can run a business and do right by people and do the right thing. They don't have to be mutually exclusive of one another. At this point, as long as I've been online and everyone knows me, I would do nothing but be honest. And if I felt that this was the time to sell and to move to another asset class, I would tell you. I would. And quite frankly, I think it's absolutely insane to even think that at this point. In fact, I see nothing that has changed, only gotten worse. The only thing that has changed is the price has been suppressed in a last-ditch attempt, if I had to guess, to get these banks that have been profiting from a short position for years to make the West and the Western system, the bond market, the currencies seem stronger than they were, and to protect the military-industrial complex because of the massive need of silver and munitions and high-tech aerospace, things like F-35s and stealth bombers and all of these things that need lots of silver.
Record buying during a price collapse is a signal the supply-demand dynamics aren't matching the screen price. As Andy Schectman points out here, when China accumulates aggressively into weakness, it suggests long-term positioning rather than short-term speculation. Historically, sovereign buyers step in during dislocations, not peaks, which raises questions about who is selling and why. If prices are being suppressed while demand strengthens, it creates a divergence that eventually resolves sharply. For investors, that means volatility now could be masking a larger repricing later. Next, Andy Schectman discusses why physical ownership may matter more than ever.
These things are now changing, and it is physical possession that will win. And when no one stands for delivery, you can suppress the price. It's just like Bernie Madoff. When no one asks for their principal back, you can win. You can run a Ponzi scheme. But a Ponzi scheme breaks when everyone says, no, I need my principal back. And that's why you've seen metals in backwardation for a long time instead of contango, because the desire for immediate delivery is far greater than the promises of paper. at a higher return. And I think it's just beginning and it's accelerating. So I'd love to come back on your show, Andrew, and pick up where we left off, hopefully not too far down the road, and see if we're right. I have a feeling that those analysts at Goldman Sachs who are talking over $6,000 silver by the end of the year will be closer to being right than where we are today. And I'd love to come back and chat about it somewhere later on down the road this summer and see how right we are.
Well, I hope everyone is positioning for exactly in that vein, because that's what the big boys are doing. That's what the global south is doing. That's where the liquidity is.
Backwardation in metals is a stress signal that most retail investors never even look at. As Andy Schectman points out here, when immediate delivery is valued more than future contracts, it suggests trust in paper markets is deteriorating. Historically, this condition appears during supply shocks or credibility breakdowns, not normal market cycles. The Ponzi analogy may sound extreme, but it highlights a key risk. Systems work until participants demand delivery all at once. If that shift accelerates, price discovery could move violently and unexpectedly. Next, Andy Schectman unravels how global liquidity is already shifting away from paper assets.
All the real key players, all the important people have now moved out of the SLV, out of the GLDs, where you can actually short a product, where you don't even know what you've got, where the actual short position of your SLV and GLD position is on someone else's balance sheet you've never seen. And when there is a problem, like we've just had a problem, and yes, you can literally try and exit all those positions, but will you ever get your physical? No, you won't ever get your physical. So really, they've lost this liquidity. And this is the point I'm trying to make, really, is proper physical liquidity is no longer here in the West. It is gone. It's finished. It's gone away. And so it's ludicrous to me that even the mainstream media still look at this market through Western lenses and say, well, look, it isn't performing very well, is it? I mean, what a joke. Andy, what a joke.
Yeah, well, and that's the narrative that we've had to fight forever. And that's why I focus on the most important thing to me. And that is that whoever is standing for delivery knows where the puck is going.
ETF liquidity may not be as real as investors assume when stress hits the system. As Andy Schectman points out here, products like SLV and GLD introduce layers of counterparty exposure that most holders never fully understand. In normal markets, that structure works fine, but during dislocations, access to underlying assets can become uncertain. If large players are exiting these vehicles in favor of physical, it signals a shift in trust rather than just strategy. That's a subtle but critical distinction for portfolio risk management. Next, Andy Schectman discusses why delivery demand is becoming the true market signal.
You don't spend billions every month here in the United States, which never happened before, where less than 1% of these contracts ever stood for delivery, unless you know exactly where this ultimately goes. And price is a tool of misdirection. When you have the narrative already controlled by a media that is bought and paid for, it's very easy to control the narrative. And, I found it interesting that the BIS came out and said what they did to the West. And if you look at it maybe the way you and I would have read it, we would have said, wow, they're kind of taking them to the woodshed, saying that the price fell because you guys changed the rules and changed the structure. Anyone else reading that wouldn't quite get it, I don't think. But I looked at it as the first thing that I had seen where someone actually said, you guys created this. You created it on the exchange. You loaded everyone into ETFs and then rebalanced them. At the same time, you raise margin requirements by 300% into that event.
The real signal isn't price. It's who's quietly changing the rules behind it. As Andy Schectman points out here, when less than 1% of contracts ever lead to delivery, the system isn't built for ownership. It's built for control. That 300% margin hike during a key event isn't coincidence. It's a forced liquidity squeeze that historically flushes out weaker hands. ETFs absorbing flows while rules shift mid-game raises a deeper question. Are investors reacting to markets or engineered outcomes? For portfolios, this means price may reflect positioning, not reality. Next, Andy Schectman unravels how these engineered collapses may actually signal a much bigger turning point.
Bang, the whole thing collapses. And it just so happened to collapse with 2 circuit breaker glitches where the markets didn't stop, just free fall. We're supposed to believe that. And these are the things that I think are being not lost on the rest of the world. I really do believe that. And I think this is one of the reasons why physical possession is so very, very important, because you're seeing the games that are being played at the highest levels. And you wonder how this all finishes out. But if I had to guess, we've hit the bottom, at least very, very close to it. It seems as though we have. We are very close to the end of the quarter. I would expect the price to turn right back up here, as all the options that were sold, as we've seen many times before here into the end of the quarter, are undoubtedly going to expire worthless. And the big banks that win all the time win. Now, the only thing that's different this time to me, if I had to guess, is that every time you and I have been talking, I was reading your stuff long before I was commenting on things. You've been someone I've been following for a long time, Andrew, and I will tell you, the only thing that seems different to me this time, it's almost as if this administration says, you've played this game too long, talking to the banks. It's time for you to get on the right side of this, because things are going to change with gold and silver. Things are going to change with strategic metals. Things are going to change with commodities. We can't play this game anymore. And maybe this is the turning event that we've been waiting for. The Economic Times more or less said, look, the banks in the United States have gone net long. Or, net long still could be 11 long and 10 short. But that last drop down, which destroyed this industry in terms of hedging and in terms of refining, and had, I think, effects far past precious metals into the refining industry, which is still blown up.
Markets don't glitch twice during a collapse without raising deeper structural questions. As Andy Schectman points out here, circuit breaker failures during a free fall undermine the very safeguards investors rely on, especially when timing aligns with quarter-end options expiry. Historically, these periods favor institutional positioning, where options decay benefits large banks while retail gets trapped on the wrong side. The claim that banks are now net long adds a twist, but net positioning can still mask hedged exposure. For investors, this isn't just volatility. It's a reminder that timing and structure often outweigh fundamentals. Next, Andy Schectman discusses why this cycle may mark a shift in who actually controls the outcome.
Maybe that was it. Maybe that was the last one. And I know, you can say that a million times until it is the last one, but it just seems that there's a different understanding at that level based upon the deliveries. The deliveries are something I've never seen before. And that, to me, signals a change in what's happening, where physical is far more important than paper promises. And I think getting on the right side of this, if you're the banks, one of these days they'll make more money to the upside as they did all these years to the downside, especially if the goal in this administration is to bring back manufacturing. The only way to do it is in a massively devalued dollar. And what better way to devalue the dollar than to let gold find its real price discovery? Because it is the only neutral reserve asset by which we measure the health of all currencies. So, a lot to think about, Andrew, but it just feels a little bit different that where, they've always been in control, and maybe they still are in control, but is it the realization that the control is waning in an environment where physical delivery and physical demand is becoming worth more than the paper promises? I think that's really what's different this time.
The controls. The shift isn't in price action, it's in who's demanding actual delivery instead of paper claims. As Andy Schectman points out here, rising physical deliveries signal stress in a system long dominated by synthetic supply. Historically, when physical demand diverges from paper pricing, it precedes repricing events, seen in past commodity cycles where scarcity breaks financial engineering. The idea of a deliberately weaker dollar to revive manufacturing aligns with policy trends, especially post-2020 supply chain shocks. For investors, this reframes gold not as a hedge, but as a benchmark for currency credibility itself.